Thank you for joining us on the Real Estate Investing Book Club podcast with your hosts, Chris and Mike.
Right. Welcome back to the Real Estate Investing Book Club podcast with your hosts, Mike and Chris. And we are getting into one of our favorite books today. Mike, you want to tell them what book we're getting into today?
Absolutely. The book on rental property investing by Brendan Turner.
I like this book. So, yep, glad to have everybody back here and talking about it today. I just want to welcome you guys back. Last week we talked about Rich Dad, Poor Dad, which was great on mindset.
Absolutely. So when we talked about Rich Dad, Poor Dad is a mindset shift. It's a paradigm shift. It's getting a person to think about trading time for money. It's changing that mentality to buying assets, not exchanging your time for money, being able to basically produce capital while you're asleep. This book, the Brendan Turner book, the book on rental property investing, is a lot more different because this is almost what I would call a technical manual. This book is a how-to. It's kind of, line by line explaining exactly how to, most steps involved with setting up a real estate investing business. So where Rich Dad Poor Dad is a mentality shift, a mindset shifting book, this is more of a technical manual. It's almost like a field manual, I think is what I've called it before.
Yeah, I think this is a good foundation. I agree with you 100%. This is a great book for your first, second, your 10th deal, how to get it, how to structure it. Really good oversight. You call it a field manual, Mike. I like that a lot. I like the fact you brought up your why and why it's important to have a good purpose in your real estate business. I think for me, that made a lot of sense. And it really kind of dive into where you're at versus where you want to go business. And I think it's sometimes easy when things go backwards or get hard. It's easy to say this real estate thing doesn't work out, or I don't have a clear path of where I'm getting. So I know something he talked about I really liked is the 4 pillars of wealth. And I didn't know, Mike, if you wanted to jump in on that and kind of talk about what that meant and how that stuck out to you.
Absolutely. Again, this is different. This is different from Rich Dad, Poor Dad, where we really get into a lot of the technical details. So, 4 wealth generators of real estate are generally the following. So, number one, you have cash flow.
Mm-hmm.
So, what's left over every month after you pay all of your expenses? So, what you take home. So, after cash flow, you have appreciation. Now, appreciation is the increase year over year of value, daily of your property when you buy it. You have your loan pay down. Daily, you have tenants placed inside of your rental property who will be paying your mortgage for you month over month. Again, that's a bill that's ideally appreciating year over year, and that's just capital that's going to come back to you if you ever decide to sell or refinance. And then the fourth benefit, which is one that's often overlooked, are just the tax benefits involved in real estate. Depreciation is generally what that's called. So that is depreciation tax benefits of real estate, residential real estate in particular, are really, I think, what sets this asset class apart from, stocks or other sorts of asset classes that investors will invest in. What they're able to claim against your W-2 income, and then just all the write-offs, for example, your mortgage interest, any sort of improvements that you do to your property. There's so many different tax write-offs that you can use as a rental property investor. It's a true advantage of this asset class.
That's why one of my mentors talks about ideal real estate. You have income, which you hit, Mike, depreciation, the tax benefits, equity build up, amortization, low pay down. So IDEA, and then you have leverage is my favorite. When I talk about leverage, how you can buy real estate. And this used to be something you could do very easily before the great stock market crash 100 years ago. You could leverage or margin call. And they still do that. But I think with real estate, you can do it not just a 50%, leverage like we used to have with stocks, bonds, but you could do X infinity. You could use 0 down and buy things and your ROI just gets crazy. So I think with real estate, what I like all the things you mentioned, in addition to, I know this book really hammers cash flow, but I think leverage is a way that you can really maximize that. We love talking about it. You and I, Mike, love teaching it. We love discussing it. Like I'm a freak about owner finance, seller financing, subject to. I think it's just a great way. And he touches on the book, but he also has another book that talks about, low to no money down getting into real estate. We won't get into that today, but I just wanted to add that point leverage. I think that's huge. So getting into cash flow concept for listeners today. For example, looking at a duplex, what do you think Turner's minimum standard for acceptable monthly cash flow is, Mike, expenses? Like if you had to kind of boil down what he got to.
Well, I think different for everybody, different for everybody's goals, what your why is in investing, what your end state is, what you're trying to achieve. But as far as cash flow goes, if you're paying say $1,000 a month on your mortgage, insurance, etc., well, anything above $1,000 a month that your tenants are paying, that's going into your pocket. So again, the formula of figuring out what your return on investment is, your ROI, in this book is great in terms of getting into some of the formulas that you can use while underwriting, while analyzing your properties to see if it's a good investment. If say you can get 5% or so from a CD at a bank, in my opinion, you should be looking as an investor for something better than 5%, and taking in mind that there's multiple ways that you can accrue capital in real estate. The four pillars of wealth that we were just talking about, all the benefits of residential real estate. This asset class really does have some advantages that other asset classes do not.
Yeah, and I think when you have some hard numbers like that, it's just easy to look and to do some educated guesses. He has a great formula he uses, and I think he breaks it down pretty well with pictures in the book. But I think it's funny when you put those numbers together, the numbers are the numbers. And you can obviously argue, debate that, but depending on your risk tolerance, the numbers are the numbers. So I thought that was real interesting. So
Yeah, it's very easy to get really wrapped up in the numbers as far as analysis paralysis is what everybody says.
yeah, yeah,
There there's a balance between digging into the numbers and researching and maybe dragging your feet. It's a balance of saying, oh, this deal does not meet my criteria. Maybe in our buy box, we can say, all right, I want a 10% return on investment, return on my investment, return on capital. So if you do the rough numbers and it comes back, hey, it's not meeting my 10% goal, return on capital. Well, maybe it's time to, just stop, move on to the next deal and not waste time kind of just digging in and trying to make a deal work. If the deal
yeah.
doesn't work, you can only do so much to force it.
Yeah. Yeah, no, I totally agree. And I picked this up. I think Mike, you have a mentor who's been doing it for longer than you and I both combined, been alive. And long story short, he uses each business, each rental property as a business and looks at the numbers. And does it make sense or not make sense? That's kind of how he dictates his decisions versus looking at one individual, his whole business as a whole. He looks at individual units. So speaking of that, getting help, getting mentors, getting people, let's talk about team members, Mike. Let's dive into this. I know you do remote investing. For you, your team is everything. So I know Turner dedicates a massive section to building a team. So who do you think are the 3 non-negotiable team members, Mike, as an investor might hire before they buy their first property? Who should they have in place?
This is an interesting topic. For me, number one, I am a remote investor. I'm not always located in locally to the properties that I own. So for me, number one, the most important person for me personally and my investment goals is a property manager. A property manager is basically my forward facing uh, representation of myself to all the tenants day to day. Hey, my toilet's not working. My lights aren't working. I broke something. I'm not handy. I'm not handy whatsoever. So even if I was local, if somebody called me and said, "Hey, my toilet's broken," well, probably unless it's something extremely simple, I'm not going to know how to fix it. And luckily, my property manager, i.e., you and your company, amazing. Could not be doing what I'm doing without a solid property manager. Property manager, people still think that a property manager is there to handle phone calls, screen tenants. Yes, those are the core elements of a property manager. But again, a property manager is your eyes and ears. The property manager can source you deals, make your life completely so much easier. Also, I would say, a broker getting in your team members, a broker's job is to sell houses and earn a commission. So as far as knowing local rents, knowing neighborhoods, knowing the real specifics of of things that are so important to investors, and brokers filters they're trying to sell you. Whereas property managers are the guys that are and girls that are boots on the ground day to day.
Yeah.
kind of really having an intimate understanding of what market rents are, the difference, the minute differences between neighborhoods, things like that. So for me, number one is your property manager
Yeah.
for me and my goals. This is very interesting. This is where I think I differ a little bit from Brendan Turner. I'll preface things by saying I'm single, not married. So Brendan Turner's number one team member is your spouse, which I totally understand. If you're an investor and you own a property, that property is yours for 24 hours a day, 365 days a year.
Yeah.
You're married to, your spouse. That again, your spouse is there with you 365 days a year. So when things are inevitably getting difficult, it's really important to have somebody there with you uh, to help you through those hard times, which will come if they will come. It's when they will come. So it's really good, and I think it ties back to your why. I think
Yeah.
if your spouse is aligned to your why, sees the long term vision of real estate and potential that we both understand is, and this great real estate business that we're both in,
Yeah.
that buy-in from your spouse is really going to carry you through, I think, when, times get hard. So again, spouse, property manager, and then there's a lot of team members here. Some team members you interact with a lot more than others,
Yeah.
but you got to think of deal flow. So if you can't find a deal to buy, if you can't find a good property to buy that makes sense, that cash flows, well,
Yeah.
that makes it pretty difficult. So, what does that mean? That means a broker or wholesaler, realtor, something like that to bring those deals.
Yeah.
Then,
Yeah.
again, how do you buy those deals? You need money, you need capital. So again, hard money lenders, bankers, mortgage professionals, they all tie in.
Yeah, yeah. No, I agree.
These,
Yeah.
these,
Yeah, no, I agree. I think you hit nail on the head. If you're married, you got a spouse or a partner for sure. I think your property manager is really critical. And then obviously broker, realtor. I think the biggest one, back up a little bit, is the IRS. I think they're going to get their money one way or another. So you have to look at it. The good news is the tax code is written for our benefit as investors, but you still got to pay your share, whatever that is, or you have to have somebody who can navigate that. So I think a good accountant, CPA, bookkeeping, those are super critical. And I think one of the things you and I've talked a lot about is as your portfolio changes, you grow or you're growing, or if you've kind of retiring, wanting to check out, your team's going to change. And I think it's really important to understand the players and who's involved. But all that being said, good attorneys, realtors, contractors, like you mentioned, having good people in place is super important. And then one of the things you really touched is finding deals. That's probably the number one question we get. How do you find deals? How do you put them together? So one would be, as you said, realtors, wholesalers, really other investors. And I think getting into that, let's kind of segue into finding and analyzing deals and what that looks like. I think this breakdown, maybe just real quick, not in the weeds too much. He did a great job kind of putting it together. If we could break down maybe the tactical steps or formulas required to evaluate a property. And I think it's really important to do this to avoid analysis paralysis. Some people love analysis, but sometimes it can lead to no action. And for me, I like to do a little bit of analyzing and then jump in, versus some people like to do a bunch of analyzing and not jump in. So I always say if a ship's tied up at shore, it's hard to steer it. So you got to get out and kind of get moving to get that property cash flowing. So Mike, let's hear your perspective on analyzing and what you think tactically breaking things down would look like.
well, I think first, it's very important to have a very clearly defined buy box, to have
Yeah.
a very clear idea of exactly what it is you would like to buy. That way, everybody can be on your same page. When I go up, when I'm out continuing my day, and I'm talking to, mailman, talking to an Uber guy, I'm talking to anybody, and then if they ask me what I'm doing, I can say I am looking for a 3-bedroom, a 2-bath house that's
Yeah.
roughly 200 square feet, and in a given 2 or 3 given areas. So number one, it's very very important to be clear what it is exactly that you would like, and what the price point roughly is of that given given property is that you're looking for. So that's number one, being very clear what you want. Number two, after that, today we're in the age of technology. We're doing this podcast right now. There's so many tools now online, artificial intelligence being the biggest one. There's so many downloadable templates out there where you can just plug and play some of the numbers. So knowing what
Yeah.
your property taxes will be in a given county, our city. All that information is readily available online. Having a rough idea of what the rent is in that given neighborhood. Again, there's some estimation involved there, depending on the condition of the house, depending on the neighborhood. But
Mhm.
a lot of those things are, very a lot easier to guess these days to make a really good, close, educated guess on. So just leveraging technology and plugging and play certain numbers to really see, okay, hey, this will give me an X number of percentage ROI. There's a number of different metrics. You can do the 1% rule. You can do the 50% rule. There's a lot of different metrics that we can use that we won't really get into. But yeah, it's just looking at a good cash on cash return. Once you plug and play those numbers and kind of analyze the neighborhood, et cetera, tax rates, what you'll be able to, what your lending terms will be from bank, hard money lender, et cetera, plugging all of those numbers, all of those different factors of a bigger algebra problem. It works out and it seems to fit into what you're looking for. I mean, take the next step, go deeper. So, I mean,
Yeah.
very
Yeah.
difficult.
Yeah.
It's good to have systems.
Yeah. Yeah.
It's good to have clear systems, and it's good to have a template so that um, penciling things out and bringing out the calculator and really digging in. Yeah, do that. If once you do the rough numbers on, the rough numbers on a napkin, or you use your rental uh, calculator, if it makes sense, go dive deep further into it and see if it meets your initial pass.
Yeah. Yeah. I think you hit the nail on the head. I think it is important first to do numbers. And there's going to be several reasons for that. One, it gives you the knowledge to know that it's a good deal and you can move forward. Two, if you are using a bank, they're going to want to know the numbers and they're not going to do them for you. They're going to do an appraisal typically and tell you if it's going to make sense or not, a value scale, but you're going to have to do your own numbers. And if you want to bring in private money, or you want to bring other people to invest, they want to know what's going on, and you have to be the one to drive that. And if you have a spouse, maybe this is your first deal you're jumping off, they want to know what's going on. So it's really important, not just for you to know and understand it, but to be able to articulate it. And I think that's super important because that helps you dial in, okay, does it make sense really? Oh, if it doesn't, I'm not going to try to sell it to somebody else because it doesn't make sense for me. So I think that's real important, especially as you're looking at new deals and new folks. So this book, I think, covers multiple strategies on that. I'm not going to dive in the weeds too much more. I think you hit it pretty well. But as in looking at the numbers and having an idea, like you said, your buy box, what kind of ratios you want to hit, if it's cash on cash, ROI, depending on what you're using, what's really important to you. And then getting into how do I find a deal. And I think he covers multiple strategies for this. I mean, he covers MLS. He talks about foreclosures as how he got started. I don't think some of these things are as prevalent. I think wholesaling's still there. I think buy and hold strategies, rehabbing. He gets to a lot of different strategies of getting into real estate. I want to focus particularly in buy and hold, but that's kind of my bread and butter. I know that's something like you talked about. Yours is to do, buy and hold because the tax strategies, tax benefits. But if you want to jump into today, what do you think, Turner, and talk about deals and finding and kind of off-market strategies? What are some things, Mike, that have kind of worked for you? I know you got a couple of deals under your belt. What has worked for you, and how did you find those deals?
This is what everybody asks. Everybody wants the home run deal. Everybody wants the 100% cash on cash return deal. But I think you have to ask yourself, what is it about you as an investor that sets you apart? Like, what makes you deserve that? So everybody asks, I want this, I want that, I want. But I think kind of what you should be asking is, what do you bring to the table? How can you help? How can you add value to some of the team members we were talking about before? And not only adding value in a business sense, but if you can help somebody out in a different aspect of life, or just add value and whatever it may be, I think you'll continue to be top of mind if somebody comes across a property that says, hey, it's that 3-bedroom, 2-bath property that fits that buy box. Well, if somebody will be like, oh, Mike is top of mind, I'm going to give Mike a call because he helped me cut my lawn, or he helped me with X, Y, or Z. So, Mike is top of mind, Chris is top of mind. This is a business, this is a real estate deal that I think would benefit him. Let me give Chris a call. Chris is top of mind. He's always been adding value to me. what I'm trying to accomplish. Let me try to reciprocate by doing the same with him. So again, I think it's just taking inventory of
Yeah.
what you're good at and really trying to help other people out, particularly in your team or, oh, if not, just in your greater community.
Mm.
So I think those are very important things.
Yeah. Yeah.
And then I just add one other thing too. The difference, the competitive advantage almost in real estate is insider trading when we're looking for deals is it's almost legal. It's whereas if we're trying to acquire a company, a publicly traded company, and we're talking to everybody and they're giving us information that they might merge or they might merge with another company or acquire this or changes in the market, we might be going to jail for insider trading if we're trying to dig around and investigate, get over our skis in terms of that. But the cool thing about residential real estate, what we're talking about is that there's no rules against that. You can try to research the area as much as you can. You can talk to as many neighbors in the area as will talk to you. You can try to really find out as much as you possibly can about any given deal you're looking at. And that's to your advantage. That's just only going to help you out. And it's perfectly allowable to do. So again, that's an advantage that we have in this
Yeah.
asset. So in this business that other types of investors do not have.
Yeah, I totally agree. If insider trading was a thing, I'd be in jail, Mike, because all my best deals would come from people I know. So that being said, just a real quick story. I was talking to a friend of a friend, and there was an IPO or initial public offering coming out for a company, and I thought it was already out. So I said, "Hey, where can I find this? Where can I get the information?" And they're like, "Well, I can't really." So the friend of a friend's like, "I really can't say anything. It's not out yet." And like, that's insider trading stuff. They gave me a heads up on that. So I have to be careful. Uh, so this is the kind of thing with real estate, it pays to be insider trading, being top of mind, like you said. Brendan Turner talks about, hey, dropping off notices, mowing grass, taking pictures of, projects for them. Tons of ways. I guess it's only as creative as you can think. If you can add value and help somebody, then you become top of mind because you're giving them so much value. They naturally want to help you. And that's how Brandon Turner got involved. He had a friend, one of his best friends, and his landlord, he start helping him and talking to him. I think things just kind of naturally happen that way. I think it can happen a lot of people that way. But you got to be the one to lead forward. You got to be the one to ask for time, offer to buy coffee or lunch, spend time with them, make an effort. I think that goes a long way. That's kind of how you and I met, Mike. We just started talking about real estate, and I was wanting to help you and let you learn, but you were also adding value to me, and it really worked out well, I think, for both of us. But let's jump into I think, to me, this is one of the most important topics. I don't want to glance over it. I want to kind of hit this before we miss it. Turner advocates for leveraging debt to scale quickly. Mike, I believe that, his debt advice, some people might think it's too aggressive for the economic climate we're in, but I pitch you why you're wrong. I think maybe that it might be too aggressive, but what do you think?
I think, well, to your point, I think it has to do quite a bit of the environment that we find ourselves in, market conditions that we find ourselves in. I think if we tried to really over leverage ourselves in 2007, I think we would see the errors of our ways very quickly. It's just again, maybe you can get away without having proper reserves or systems or really, not thinking so much as a property manager, not thinking so much as make sure everything's working, make sure, maintenance toilets are working, lights are working, all that. Not so much, maybe stop thinking as a property manager, take a couple of steps back and think as a portfolio manager, think as an asset manager. So if you have, let's say, property that costs $100,000 overall, let's keep round numbers. It's very important to really have some capital in reserves, 5 to 10% in reserves, to have enough in reserves to pay property taxes. And then if there's any maintenance that comes up, or if you buy a property and the roof is 30 years old, well, the average lifespan of a roof is somewhere around 30 years old for a regular shingle roof. So again, taking a few steps back, thinking is putting your portfolio manager hat on, not your property manager hat, and thinking, okay, I have enough in reserves, I have enough to pay property taxes, I have enough to do capital expenditures, meaning replacements, major replacements of a property rather than repairs to property. If you have those reserves allocated while underwriting the property, I think then yes, maybe since you already have underwrote that, you've already set aside some of your funds, then maybe it makes sense to take out more debt to leverage yourself a little bit more. But again, it's a slippery slope. Again, you can't say one way or another. Risk versus reward.
Yeah.
So it's without seeing every single numbers and how they play in. Again, I'm not trying to give a political answer, but I'd say I'm all about taking risk. I'm all about expanding, but within reason.
Yeah. No, I agree. I think one of the things he talks about too is, growing. So where you're at in your cycle, if you're trying to grow to get to say your first 10, 20 doors, you are going to have to take more risk. I always say you're going to be unbalanced. You just are. You're going to have more time, energy, effort. You're going to be looking harder. Once you hit the portfolio from where you want to go, start out to where you want to go. Once you kind of hit your goal, you've arrived, things change. So obviously being new, you're going to have to analyze deals and take some risk to get going. That's also part of how you start scaling. With no risk, obviously no rewards. Man, there's so many good points in this book, Mike, from we didn't even get into, his management style and how he manages properties, to BRRRR method, to cash for keys, one of my favorite things to do, and third-party inspections and having contractors, how to get good contractors. A lot of good gold nuggets in here. But if you had to wrap this up and give this, a scale 1 to 10, what would you say? 10 being the best, 1 being the worst. What would you give this book, Mike?
This book has a special place in my heart. It's one of the first books I read when I decided to start going down the residential real estate investing rabbit hole.
Yeah.
I give this book a 9 out of 10.
Nice. Yeah, I agree.
I'd say if you kind of follow every step of this book to the T, I think you can pretty much be able to start a real estate investing business.
Yeah. I think this is a great overview, a great kind of field manual. It's not all inclusive, obviously, but it is a great kind of field manual to refer back to and kind of use. I totally agree. So I give it a 9 as well. I'll give it a 9 out of 10 as well. So I think it's a great book. A lot of good talking points in here, a lot of good stuff in here. And even rereading it and kind of going back through and dissecting it, reading it before, it was super helpful. Even though he read this at time before pre-COVID and what was going on there and how prices went and some of the things he was doing. There's a lot of good stuff in here. So, hey, appreciate everybody joining us today. Mike, thank you for your time and popping in today. And I just want to thank you guys for listening and popping in. And you can once again join us at the Real Estate Investing Podcast and check us out on YouTube or wherever you find your best podcasting platform. So with that, thanks so much for joining us today.
Thank you very much.
Thanks, guys.
Thank you for joining us on the Real Estate Investing Book Club podcast with your hosts, Chris and Mike.